Hi guys, welcome to the first video of a 10-part series on fundamental analysis and everything you need to know to become a fundamental analyst in the market, really. And in episode 1, week 1, video 1, we're going over interest rates, which is really the core foundation for all of the fundamental analysis is about. And if you can really get your head around interest rates, that is ultimately what does move currencies up and down in price. So without further ado, let's get into it. So interest rates are the cost of borrowing money and the reward for saving money. Everybody in their bank account, it will say the interest rate that they're currently on. And every year, they'll get paid an X percent into their account of maybe 1, maybe 2, maybe 3%, depending on what your bank offers. And this is basically you are rewarded for banking with your bank, and they'll pay you interest to bank with them. They'll pay you money every month, every year, or every month in interest. So with trading, in a sense of that, is that countries are having to change their interest rates all the time, dependent on maybe inflation, depending on different economic metrics. So sometimes inflation gets too high, and then they have to lower interest rates to bring inflation down. And sometimes inflation gets too low, so they have to increase interest rates to start building up the economy again. So here's a chart of USD JPY, right? And people ask, well, Ben, why is USD JPY been in an uptrend for so long? Well, this is because the Japanese yen has had a very, very low interest rate compared to the US dollar. So if you were choosing a bank here, which one would you choose? Bank A or Bank B? For me, I'd rather go with Bank B because they're going to pay me more interest on the money that I give them. So, which bank though would you like to borrow from, right? If the cost of borrowing is smaller with lower interest rates, I'd rather bank with Bank A. So I'll choose Bank A to borrow with and Bank B to save with. So what investors do around the world is they do this. They borrow from the Japanese yen and then they put their borrowing money into the USD dollar, which has a higher interest rate, right? So they can borrow for £1, and with that £1, put it into Bank B and make more money putting it into Bank B than Bank A would, right? So, if you're a business, for example, and you want to borrow £100,000, the bank will charge you maybe 3, 4, or 5% interest, and of course, I would rather be charged less interest. So I'd rather go with Bank A. And how does this tie into trading? Well, the fact of the matter is in interest rates, there's these things called carry trades, right? So carry trades are where investors borrow from lower interest rate countries and economies and banks, and they invest in higher interest rate countries and economies. This is what a carry trade is. So let's go to, for example, the Euro USD dollar. Why has the Euro increased here over the US dollar? Well, that's because they've been increasing rates higher than the US dollar has. So the Euro, let's say, was 4% interest and the US dollar is 2% interest. Investors will borrow from the US dollar and save in the Euro. And that's exactly what's happening all the time in all these currencies. For example, I'm in a trade right now in AED JPY. AED JPY's interest rates are currently 4.10%. However, Japanese yen is only 0.75. So I'd borrow from the Japanese yen and I'd save in the Australian dollar. Hence why the Australian dollar has increased in value above the Japanese yen. Now, there's 2 websites I like to see for this. There's the rate probabilities, right? For example, you can see the current rate in Japan is 0.75, but you can see coming up in 15 hours and 4 minutes, we have a possible interest rate meeting where they could hike rates. Now, what does this mean if they hike the USD, the Japanese yen? Well, this means investors are making less in the carry trade. So at the moment, they may be making 0.75, and then the Australian dollar is 4.10, and then this may increase to 1%, right? So they're making less money than they were before, which means you may see less bullish strength in something like this. So I'm always looking at interest rates as the first thing I look at. When I look to trade an asset, I'm looking for an interest rate differential where when I'm buying the New Zealand dollar, I want to be seeing that as the saving currency. I want to be seeing that as the higher interest rate currency. So I want to see NZD have 5% interest rates, for example, and Japanese yen to just have 1, right? And that means if I'm buying the New Zealand dollar against the Japanese yen, I want to see the interest rate differential there, okay? And then I'm saying, well, in the future, are they looking to hike rates or lower rates? And you can just see that very easily by going here. At the moment, it doesn't look like they're going to higher rates. This is called rateprobabilities.com. It's a very, very nice website which people can use. I can leave it in the description below. But you can go to all of these different Bank of England, again, unchanged. Bank of Canada, the Bank of Canada is coming up in 2 hours, but it looks like they're not going to change their interest rates. However, AUD, it looks like it's going to be a 76% hike, which means AUD is going to get stronger in value. When interest rates go up, the currencies also increase in price. And you can see that on a chart. For example, if I do go to Euro USD, and I go to Oanda here and zoom out, as you can see here, you can see that Euro cut interest rates over here, okay? And when they cut interest rates, the Euro lost strength against the US dollar. Here, USD increased interest rates. So the Euro, again, lost value against the dollar, because the dollar, if you are buying Euro USD, you want the Euro to strengthen over the US dollar. But if they're increasing interest rates over the Euro, then the US dollar is going to become stronger than the Euro, meaning that the chart should go down in value, right? And that's how I trade. You know, I'm looking for interest rates to be hiked, to be lowered in the future, and if it looks like they're going to get lower in the futures, investors will take their money out of certain currencies and put them into currencies with higher interest rates. And you always want to be trading where higher interest rates are when you're looking to long certain assets. So the other great website I use is to backtest this. You can go on to investing.com, central banks, and you can come to this page and you can see the interest rates for the Fed, for the ECB over time, and you can compare them and you can understand yourself what happens, right? So the Bank of England at the moment are lowering interest rates. Let's see if GU is going up or down. Well, we can just look at the currency itself, the pound. And at the moment, the pound is actually losing strength. And actually, I had a position on the pound, as you can see. I was looking to short the pound. Why was I shorting the pound? Because interest rates are lowering, which means investors are taking their money out of the pound and they're putting it into other currencies with higher interest rates, like the Australian dollar, like the US dollar, right? If we go to the US dollar at the moment, we can see pound USD, just here, and you can see it losing strength against the US dollar because the US dollar currently has higher interest rates than the pound. And this is how markets move. Hopefully you guys understand now what interest rates are and how you can use them to trade. And make sure you subscribe for the next video series where we go over different inflation figures and see how that affects interest rates.